It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. Right here with me in the KFG studio is my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
So, Mike, health insurance remains one of the most important factors in your ability and the timing of your retirement. So if you're retiring before 65, what are your options for health insurance, and how would you rank or prioritize those options? We're going to hit that and much more coming up on this episode.
If you are a fan of the Wise Money Show, you might notice a trend. Sometimes we get a little long-winded, and we don't always get to listener questions. And so that's why if you engage with us and ask a question of the show, we're gonna answer your question, okay? But we're gonna put it in the queue and hopefully hit it on an upcoming program. And I want to let's hit questions today.
Questions
okay?
Today it is.
Okay, so you can submit your question online, wisemoneyshow.com. There's a spot right there on the right. You can text your question in to us, 574-222-2000. That's 574-222-2000. Most people leave questions, engage with the show on social media. You can do so wherever you're at. We are there as well. A lot of them come on the YouTube channel, leaving comments and whatever questions. Got a couple great questions recently. Again, we're gonna answer them, but hopefully we can hit them on an upcoming program. We plan to do that today. So reach out to us if you have questions. Last week we talked about this retirement boom, and Josh said there's really not a retirement boom, it's just the baby boom, and they're retiring. And Kevin and I said, no, you're wrong. Prove us wrong. You can't. And so more and more people are retiring early, and that's leading to an enormous problem, right? Retirement planning, you've got to look at all 6 areas of your financial life to say, can I do this? And what are the trade-offs? Am I ready? But you've got to solve a few problems. And you would argue the biggest problem you've got to solve is, what are my health insurance choices if I'm not yet 65, okay?
Doesn't it feel like this is the one that scares most people away from early retirement?
Yeah.
You know, maybe they've got a nice nest egg. Maybe they could start drawing Social Security at age 62, or if they lost their spouse, they could draw it even earlier. At age 60 is the absolute earliest in some circumstances. But just because you have all those other ducks in a row, you get down to figuring out health insurance, and people sometimes get sticker shock when they see just how much that would cost, or they get overwhelmed by figuring out, boy, how do I replace what was previously just done for me, by my employer? Maybe you're coming off of a group health insurance plan. So this is a big topic, because it may be the one thing that is holding you back from marching into retirement a little earlier than what maybe you otherwise were planning.
I'm serving some folks who own a business, and they've done very well, and they've saved, sacrificed a lot. They're selling the business, but they're 63. And part of the negotiation is they just don't want to venture into this land between, and they're saying, I'm selling the business, you are the owner, but I'll stay working a little bit, which is probably good, and I need benefits. And they're structuring that in the deal because they don't want to go into the land of unknown with health insurance.
Yeah, so if you're listening and you say, what's the big deal about 65? So 65 is where Medicare begins, and you're eligible for Medicare. Now, in some unusual circumstances, you could be eligible for Medicare before 65, but just think if you're 99 point whatever percent of the population, at 65 you're eligible for Medicare. So that's the government-run healthcare system for elderly folks. And a lot of times people will confuse it, and it'd be easy to confuse Medicare or Medicaid. Medicaid is for indigent people or people that don't have money. And so the government has said, look, Medicaid is part of the social safety net. And in reality, Medicare is part of the social safety net as well. It's a government program to make sure that there's fraud and waste and Stop it. No. But it's to make sure that people don't go without health care. Yep. And so if you say, well, what then at 65, what are even my options before 65?
Yeah, and that's what we're hitting right now. And there's three primarily. And helping with this, we're not only going to talk through these, but we're going to prioritize them. And because you've got to look at, Kevin's saying there's 4, I'm saying there's 5, Kevin. Fine. There's 6.
Prove me wrong.
So the first one that you've probably got to look at and consider, you're retiring either by your choice or it's forced upon you, and you're not yet eligible for Medicare, is make your spouse go back to work. I'm just kidding. Is COBRA. Is COBRA continuation of benefits?
Honey, go to work.
Yeah. So guys, what's COBRA other than a pretty scary snake?
It's the Consolidated Omnibus Budget Reconciliation Act of 1985.
Yeah, so
What a good
another
year.
government acronym here. But basically, that was a law that said if you leave your employer, it allows you to have continuation of the same health insurance plan that you had under that employer. So in many ways, I guess it's appropriate that we're starting with this one, because if you worked for a large employer and they had group health insurance for you, you can continue what you have. And so that becomes really kind of the benchmark, I guess, that if you were going to pick something other than this, it would be because that something else was better than this,
right,
or cheaper than this, or whatever. But, you know, a lot of people would look at COBRA as almost their preferred one because it's the known quantity. It's the health insurance that you're used to, and you know your doctor's already, you know, qualified or covered under this plan, that sort of thing.
And I wouldn't say known quantity. You're
Yeah,
right,
the
because
price tag's not known, you're right.
The price tag of COBRA, a lot of times people think COBRA and they think, okay, my health insurance is staying the same. You're right. Your health insurance is staying the same. The cost is not. Well, wait a second. That seems unfair. Yeah. Your employer is likely providing some sort of cost covering of a portion of the actual health insurance premium. So you have to pay for COBRA. You've got to pay, unless there's a retiree medical benefit that your employer is structured. You've got to pay the full cost of the health insurance, plus oftentimes a 2% administrative fee, and pretty much everyone charges that. So if you were paying, half the cost, or if you were paying for your dependents but not for you, and your company was paying for a portion of it, when you go on COBRA, you've got to pay for the whole thing.
And that is what would make a 62-year-old who says, "Hey, I want to retire, and my Social Security benefit is $1,500, and my COBRA payment is $1,200." And that's what gets people to say, "Hey, you know what? I have actually seen COBRA with a family program, $2,400. I mean, you some of these numbers, you look at that and you say, I wouldn't pay it.
But you're instantly grateful for your employer who was paying that all those years, and you maybe never even realized just how expensive your health insurance was until it's offered to you at full freight, full cost on your shoulders. But it gives you potentially, an 18-month window of time where you're protected under the insurance that you've known for so long. And for some people, that's enough of bridging the gap between when they retire and then qualify for age 65 Medicare, as Kevin was explaining earlier.
So a couple other details here about COBRA. Yeah, there is a limit. It's 18 months. There are some circumstances where you get it for 36 months, but retirement isn't one of them. If you retire, either voluntary or involuntarily, it's 18 months. That's as much COBRA as you get. That's it. There's no way around it. So that's one item. And then second, your employer-provided plan needs to offer COBRA. I mean, most of them do. It's sort of a given, but it's not actually a given. It's not a guarantee. And so you've got to see cost, is it available, and it's going to last for up to 18 months.
Yep, that's the key right there.
Yeah. All right. What are your other options? Again, I think it is sort of the benchmark, like Josh said. That's sort of the standard. You look there first. Where do you look second? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. If you're not a subscriber, hit that subscribe button, turn on notifications, and smash that thumbs up button. What you're watching right now, this is our weekly 1-hour talk show that airs right here at 10 a.m. every Saturday, as well as on our podcast and on a few local radio stations in northern Indiana. Throughout the week, we also have additional smaller, 10-minute, 9-minute, 7-minute, whatever, next wise steps, taking one financial concept, applying it to your financial life. So make sure you hit that subscribe button, turn on notifications, smash that thumbs up button, and engage with us. Leave comments here, leave questions here. We'll get back to you. All right. Thank you very much. Anything else on COBRA? And we can then go right into healthcare.gov.
So I just have an interesting situation right now. I have actually a number of clients who are retiring from an international company, and their COBRA is 36 months.
Oh.
Does that make any sense to you?
I can't even remember what the 36... I'm not looking it up right now.
It has to do with spouse with dependents and maybe if you passed away, I think, like if it was a surviving spouse situation. But it's rare, and you have to fit just perfectly in those requirements in order to be eligible.
Mm-hmm.
Yeah. So I don't know that the timing does make it interesting.
Mm-hmm.
Yep. All right. So we can, at least mention that public service announcement sort of thing, and then, and I'm assuming there will be comments from folks saying, "What about this? What about this?" with COBRA, because it's a little unique. And then we can get into all the uniqueness of Affordable Care Act, healthcare.gov. All right.
I'm tempting fate.
Kevin's sneaking a. That thing is going to crunch.
You have to throw him a question early in the segment. Hurry up. Let's go.
Any bets on whether or not Mrs. Corhorn says, "Hey, when did you eat garlic today?" Like I can walk in the house.
That's a garlic bagel?
It's an everything bagel.
Oh, good.
You probably got a text.
I can walk in the house and say, "Hey, honey, I'm home," and she'll be in the basement, as far away from me as possible, and she'll say, "Hey, what'd you eat today? You get some garlic today?"
That's funny. All right. What are your options for health insurance when you're retiring before you're eligible for Medicare? Okay, at 65, if you're retiring early, what are your options, and then how do you prioritize those options? We're talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. Here with me in the KF2 studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then wherever you're at on social media, we are there as well. Search the Wise Money Show. Follow us there. Submit questions there. Engage with the show in that way. All right. So if you're retiring before age 65 and you're not yet eligible for Medicare, typically you're going to look at COBRA first, okay? Because you know what the coverage is. You've got to figure out the cost. You've got to make sure it's offered. You've got to see if 18 months, which is the limit, is enough time. But typically you're going to look at COBRA first. Now, Kevin, you mentioned, for many cases it's 18 months, but there are some circumstances where it might be 36 months, and you're eating your bagel right now trying to have breakfast, but I also want to put you on the spot. And what's the other perspective there?
Well, you would want to know, first of all, when you look at that's funny, Mike. So when you look at 18 months as the magic number, that can drive the decision: do I work until I'm 63 and a half? But again, that's just COBRA. That's one of the four, as we had mentioned. There are 4 different options that we would want to consider. So because you say, well, what if there's a meaningful gap in the age? What if I'm considerably older than my spouse? I get to 63 and a half. I can go on COBRA until 65, but my considerably younger spouse won't be 65 when I am.
Right, exactly.
So COBRA creates some interesting story problems to be solved. And again, there are exceptions. If you're in the military and you're called into duty, you could have COBRA for 24 months. If you're there are a number of other exceptions which could have COBRA last up to 36 months.
It's interesting that you bring up the scenario where you have spouses of different ages, and one gets within striking distance of retirement, they can go on COBRA and bridge the gap. That's fine. But sometimes when you have a younger spouse like that, yes, we can hear your bagel, Kevin. It's not distracting at all either. When you have a younger spouse like that, it is often the reason why sometimes spouses don't retire at the same time.
Yep.
You know, maybe that younger spouse needs to work a little bit longer until they get close enough to go on Medicare, or come up with a different option like we're talking here. But you know, a lot of people would love to have both spouses, even at different ages, retire at the same time. But health insurance has to be figured out. That's why we're doing an entire show about this.
Right. So when you look at this, and this may be the best time to talk about the four main options that you would consider. Now, some people might say there are more than four, but I wouldn't pay attention to that. So you look at COBRA coverage number one, but the other thing is you might want to, and Joshie is saying, hey, you got the younger spouse. The younger spouse may need to remain in the workplace for coverage. Well, one thing that you might consider is, hey, even though I've always been on my spouse's plan, maybe we reverse roles here. Mm-hmm. And so you look at, because again, this is part of the planning piece. So you say COBRA is one, my spouse's plan is another. Then there's the public marketplace. So we talk about the Affordable Care Act, Obamacare, whatever you want to call it. That's where there are government-funded premium tax credits that you want to understand, and there are a number of other things there. But there's also private insurance. So whether it's trade groups or things like that. Mike, you said there was a fifth one. To me, the fifth one is, what kind of deal can I negotiate?
See, the fifth one is more of a brainstorm. Listen to this. And this is a quick tangent. But listen, you've got to insure your kids on your health insurance up until what, age 26? I think they should make a clause where if you're 60 and you don't have health insurance, you can go back on your kids' insurance. That's what I think. They make your kids cover you. Right? You've got to now cover these young adults until age 26. Why? Oh, someone decided that. That was the age. Why not? If you're age 60, you can do COBRA, you can do Medicare, healthcare.gov, or you can be added to your kids' insurance as a dependent.
Some aspiring politician is listening to you right now, and you just set them on a campaign trail.
Yeah. I love that idea.
Their whole platform is going to be based on this.
That's obviously a joke, but I love that idea.
Mike for president.
So let's go into let's go into that second option. I mean, this one, there was some, and politics. We're going to sidestep the politics here. I'm not going to get into whether we should have Affordable Care Act, whether it's meeting its obligation. It's certainly not. Whether it's actually doing what it was supposed to do, whether it's constitutional. But we've got Affordable Care Act. We've got the marketplace. We've got healthcare.gov. We've got Obamacare. By the way, those are all the exact same thing. And that's typically option number 2.
Mm-hmm. And the nice thing is, I mean, you have these plans that you can access through a private insurance company, but you go shopping for it in the marketplace, in this government-run website, essentially. And the reason that you need to be aware of this one or just understand how it's structured is it requires more careful planning, in my opinion. The income level that your family has and the size of your family, how many people are in your household, it determines whether or not you're eligible for certain subsidies that are baked into this. There are things called a premium tax credit, which is basically you getting some money back on your tax return or potentially up front knocked off of the monthly bill, the premium. And it's all based on kind of means testing, essentially.
400% of the poverty level for your size family. I mean,
right. Well, so for sure, if you're considering the public marketplace, you have to be doing tax planning.
Yes.
Because this is where I have seen the insurance agent makes a recommendation, the tax preparer, because you want to say tax planner, but most folks don't get planning, they just get prepared. So the tax preparer makes another recommendation, and then the investment professional, who's completely delinked from the other two, says, "Oh, that's fine, Mike. Take this money out of your IRA to buy the new car."
Right.
So what did we just do to Mike's income that year? So all of a sudden, you have this perfect storm where these three people who are all supposed to be working for you, if they're working for you in a silo or in a vacuum, they're not going to be helping you.
Exactly. That's the danger of having a financial plan that is not integrated, or a collection of financial professionals that are not collaborating together. And so to me, you need to have a certified financial planner in your life who's helping to pull all of that together so you don't step on that minefield or that landmine. And really have a potential tax trap. Maybe you consider it a health insurance trap. Maybe you consider it an investment trap there. But the point is, there's lots of mistakes that you can make as soon as Obamacare is a part of your life. That's not to say that this is a bad thing or it's not a good option if you're going to retire early. It's just one that you have to approach very carefully. And just to give you some perspective here, in the year 2021, your income, if it goes over $68,000 for a married couple, you may start to lose some of those goodies that we were talking about.
It underscores the need for planning. Who would have thought you need to do tax planning for your health insurance? I'm going to tell you, we see lots of these examples. I'm going to share an unbelievable example in just a moment, and then we're going to talk about the third and fourth options for health insurance pre-65. That and more coming up on the Wise Money Show with Korhorn Financial Group. Would you say go private insurance before looking at the market? What are you saying goes before?
I'm saying
Cobra.
I'm saying you would consider. I got to consider Cobra.
Yeah.
I might need to reconsider what my spouse has, because I may be able to hop on her plan, or she may be able to hop on my plan, depending on who's doing what. But a lot of times you say, well, of course you'd look at that. Well, that isn't always that obvious. So I would consider my spouse's plan.
Right.
And then I've got the marketplace.
Yeah.
I have to consider that. But the other thing that I would consider is the private insurance, because you've got these.
I thought you were saying private insurance goes before the marketplace. I'm like, well, if you're looking at private insurance, look at the marketplace first, see if you can get a premium tax credit.
For sure.
Right.
Yeah. All right. So I've got a story highlighting that was this week, highlighting the benefits of tax planning with healthcare.gov, and it's going to summarize it, and then we can go on to.
So I'll tell you why you don't eat during the show, because if you eat a bagel, it's quite possible that the splatter screen right here has an actual drip running down it.
Oh my goodness!
That was a big splatter.
There's sesame seeds all over it too.
Hey Josh, remember when you had to sit over there and use Kevin's mic and when he was out?
Can we order a backup mic, please?
All right, so what is this? This is start of segment 3. All right. Okay. Healthcare.gov or the Affordable Care Act, there's unbelievable tax planning and financial planning opportunities available. I'm gonna talk to you. I'm gonna tell you a real life story here coming up. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it, turn on notifications so that you're made aware every time we drop a new episode or a next wise step or some other video throughout the week. So go check that out on YouTube. All right, so we're talking about when you retire before being Medicare eligible, 65. You think they'll ever move that age from 65 to 70?
Well, I think they're going to have to. They'll move it out of necessity during a time of crisis.
I think so, too, which, unfortunately, a time of crisis is a time for crisis and for many Americans. And that's, it's not just we can't have a government financial crisis without a population financial crisis. It's going to be bad news.
Yep.
But, they've already done that with Social Security. That's created a lot of confusion. They delinked Social Security drawing age and Medicare, and it creates a lot of confusion. So anyway, you're not yet 65, not eligible for Medicare. What are your options? You got to consider Cobra. You got to consider, bribing your spouse to go back to work, or that's a joke. But if they've got coverage that maybe they've always thought, well, this isn't good. You got to look at their insurance. You got to look at healthcare.gov, which is the marketplace. I was meeting with some really close friends. I mean, your financial planner genuinely, authentically needs to really care about you. Not just chin music, not just, being nice to you. Like, we just care intimately about our clients. And they become friends. And I've become really, really close friends with these folks. And his company was shut down, and he was thankfully able to retire, so transitioned into retirement earlier. His spouse has been battling cancer, stage 4. She's been in remission, but she stays on treatment. And right as he was transitioning to retirement and off of Cobra, she started having COVID symptoms. COVID test? No. But negative. Well, false positive? No, negative again. And then more and more symptoms. Goes to the hospital, and they do a quick CT scan. On Tuesday evening, they find out she's got a massive brain tumor. On Thursday morning, she's in the operating room getting that thing removed from her head.
Wow.
Right at the time when Cobra's running out. No, I'm not kidding. So we've got a decision to make. And so they've saved up, and they're financially ready to retire. But we've looked at their financial situation. He's blessed. He's got a pension, about $3,000 a month. Wow. I mean, that's hugely helpful and helps him retire. But they've saved up a lot in cash, and then he's got a little inheritance. And so for these first couple of years of retirement, we structured it so he's going to have his pension, but then they're going to spend cash to supplement their pension. We've done all the capital gain stuff. We're not going to sell anything. We're not going to take anything out of IRAs. Their income is going to be around $36,000. They're going to be able to get family medical insurance through the marketplace for a couple $100s a month because of these premium tax credits. It's not based on their net worth, which might in the future be a qualification. Right now, it's just based on income. Their net worth is significant. Their income will be small because we've got control over the sources of it. And if you look and say, well, that's not really fair. Let's talk about fair. I mean, she's got a brain tumor. She's got cancer. This is an awful situation. It's just how the rules work, and we're being planful with it. That's the approach that you need to have as well. After looking at Cobra, your spouse's potential coverage, and Affordable Care Act, what's the last option?
Well, there are some programs out there that are essentially cost-sharing programs. Usually faith-based organizations where essentially it's not a premium technically that you're paying each month. It's you contributing to the coverage of other people's expenses. And, somewhere along the line, it may be your turn to turning some claims, so to speak, some medical bills that others would help you with. And, there's certain religious groups. I think of the Amish, for example, here in our own backyard, who have done this always. They have approached health concerns, or someone loses a barn or has some sort of catastrophe that befalls them. And what happens? It's neighbors who come to their rescue. They all support each other. It's a true community. Well, essentially, that's what's being formed with some of these Christian cost sharing arrangements. It's creating a community of strangers who are going to support each other essentially with these costs. And it's not technically insurance, but it does qualify as insurance for Obamacare purposes, that sort of thing.
But it does not qualify to let you make an HSA contribution.
Correct.
That's one of the stinkers about that type of an arrangement.
So you've got to look at what are your private or individual health insurance options, and so there are some. There's not a lot, and then there, coupled with that is these these health care Christian share plans sort of things. Those are not insurance. It's not insurance. It is like raw insurance. Really, it's how insurance started with a lot less bureaucracy. I mean, but we have to, and your certified financial planner has to tell you, well, that's not insurance. You know, Josh, you pointed out a while ago that no one likes their health insurance, but people actually really like these share plans.
I always ask people, you know, when I find someone who has been using this, I always want their opinion on it. And to this day, I still have not found someone who complains about it. Mm-hmm. And you're right. I mean, we keep saying this is not insurance, but it is a form of risk management. That's what insurance is.
That's right.
It's a tool. It's a way of dealing with potentially a catastrophic loss. You don't know in this whole group of people, thousands of people, which one's going to get the cancer diagnosis, which one's going to have a sudden heart attack or a stroke or need a major surgery or whatever. You don't know if it's you or if it's your neighbor or someone on the other side of the country. But by kind of banding together and saying, hey, we're all going to pay a little bit of this cost, it deals with those potentially catastrophic expenses without bankrupting yourself potentially.
Really quick before we just put the bow on this thing, I haven't seen. I agree, Josh. I've seen lots of people even use that share coverage and with success, and they like it. I haven't seen anyone have a terminal or major issue. I've seen someone cut their thumb off, you know, and have some other issues, but no one I haven't seen anyone get cancer, and I don't know how it holds up in really bad situations like that. But then the other thing is, it's a reimbursement type of program. So you got to front the money. Right. And thankfully, hospitals, their billing is just disastrous, right? So you don't get a bill for, I had surgery 18 months ago. I'm still getting bills, right? So, but you've got to come up with the cash at first, and then you get reimbursed.
Yeah, and I have heard from folks, they've waited 4, 5, 6 months to get reimbursed. So again, don't hear this as an endorsement of any type of program, but just to know these programs exist, and I would look into them.
So those are your options to retiring before 65 and what you should do with health insurance. Which one's right for you? Work with your certified financial planner. Work with your certified financial planner who's doing comprehensive financial planning, who's helped guide you to prepare for retirement, guide you to get you over that threshold before 65. This is why we have health insurance experts on our team, so they can collaborate with our planners, sit in the same office. A lot of times, a client's meeting with one of our health insurance experts right before the financial planning meeting or together. That's the type of service and experience that you need to get the best advice. All right, we've got questions from fans of the show. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Cool. I have not even looked at the questions. Man, we got some good questions recently about. Oh, I'm gonna do this one. Did you take any of the YouTube ones and throw them in there?
Yeah, they're at the bottom.
There's a really good one that I want to hit. About what are my other options for health insurance or for Roth? Vanessa. We're going to hit Vanessa's first.
You lose the ability to, or most people lose the ability to contribute to a Roth IRA when you file separately.
So I responded with a couple ideas, and I want to hear from you guys if those ideas actually.
So you're going to share them?
Yeah. Let's talk about that one first. And then we'll go Mark. We'll go bottom up. Vanessa, Mark, Karen.
That is fascinating.
Those are, we get a lot of engagement on the YouTube. It's good. And not all of it's bad. I'm talking to you. Be nice. Okay. All right. Thanks for being with us. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just check it out. Search Wise Money Show. Sometimes you got to type in with Korhorn Financial Group. If you do, it's Korhorn with a K. And make sure you subscribe to it there and then rate the show. Leave a comment there as well. We appreciate that. Man, I love getting engagement with the Wise Money Show, either through questions online, wisemoneyshow.com, or wherever you're at on social media, submitting questions. We get most of them on the YouTube channel. We've got a few really good ones. Embarrassed to admit these are back from December, but really, really good. First one comes from fan of the show, Vanessa. She said, from my research on the IRS website, my husband and I technically don't qualify to contribute to a Roth IRA because we're married filing separately. We had opened a Roth IRA each, but came to find out, and we had to pull out the money we put in. We'd really like to start the Roth IRA, but this rule is holding us back. We just don't want to have issues with the IRS when it comes to tax season. Is this true? What do you suggest? And she even wrote in there, they've talked to other financial planners and they have no idea. And so here's the deal. Here's the deal we're going to make with each other. We're going to throw a bunch of concepts and the financial planning process, thought, and creativity on the airwaves and on YouTube. And we're going to ask you to engage. And if you have questions, just reach out to us. I don't know if I'm going to get to questions every week. I don't. So I'm going to answer. We'll get back to your questions. We will answer your questions. And I did to Vanessa. But we've kept it in the queue. And I want to talk about it on the show so that it can help not just Vanessa, but other people who would listen. And I responded with, yes, that's a real issue. And you might not know this, but can you contribute to a Roth IRA? Well, it depends on what your income is. If you're single, what is it? About
140 grand. You start getting phased out. This is a married couple that we're talking to.
Right.
And so for the year 2021, when your income goes north of 198, and then you start being limited on how much you can contribute outright to a Roth IRA. Once you get over 208,000, you're done. So Vanessa's kind of telling us, hey, our income is north of 208. They've been ruled out. Well, maybe she's not saying that. It's because of the married filing separate that is the issue. Right?
Your AGI then is 10 grand, right? If your AGI is over 10 grand, you can't. I think that's the number. I don't have it right in front of me.
If it's less than 10 grand, you can do a reduced amount, and north of 10 grand, it's zero.
Nothing, right?
And so you might look and say, well, that's not fair. I didn't make the rules. I don't really understand it either.
But also, you had to, married filing separate, and you lived with your spouse during any time during the year.
So here's the first thing I would tell you, Vanessa, or anyone that's in a similar situation. We did a show a few months back about, well, should you consider married filing separately? And maybe you should. Maybe you should. But I'd first want to make sure you're not just doing that because you think it's the best idea, that it's actually been proven, hey, there are legitimate reasons we should do this. This is in our best interest, either for personal reasons or for financial reasons. But let's say you've already done that. I immediately reached out to Vanessa and said, listen, yeah, you do hit that limit here. What about a backdoor Roth? Mm-hmm. And what about after-tax contributions to your 401k?
Yeah.
So because I don't think, and you can look it up, I haven't, but I don't think there's that same IRA limit married filing separately, right? It's just
Correct.
the Roth.
Right.
So you can contribute to an IRA and then just convert it to the Roth. Right, that's a way to sneak some money into the Roth IRA, and
but be careful if you have other IRA balances.
That's right.
I mean, for every gimme, there's a gotcha here.
Exactly. Yeah. So, but then there's some creativity. Okay, so here's the thing: your financial planner should provide clarity and confidence on where you stand in your financial life, what your goals are. Are you on track? But they got to provide creativity too. They've got to know something you don't. Potentially from their perspective or whatever. They've got to challenge you in a certain way or whatever, help you get there. And creatively, you don't want to have an IRA, pre-tax dollars in an IRA when you're doing backdoor Roth. Well, you could move your pre-tax IRA money into your 401k. Now you don't have any, and then contribute to a backdoor Roth. That's one option. That's predicated on you having a 401k. I get that. But then the other sneaky way to get money into a Roth is if your 401k plan allows for after-tax 401k contributions, you can contribute after tax. And you say, well, why would I do that? because then, if your plan allows, you can then roll that after-tax money directly into your IRA, and usually you can do that while you're still even working. It's not something you just need to build up for in the future. Most plans allow you to do it. If they let you do after tax, they let you roll it over once a year, sometimes twice a year, to your Roth IRA.
How old is Vanessa? Do we know that?
Don't know.
No.
So
From the picture, she looks relatively young, but I don't trust any of those pictures. Right.
from my picture, I look relatively muscular.
My picture is actually my son Kuiper with a mohawk, which he never has, but that's my picture. So
and that is, and to me, my brain goes to, why would someone be married filing separately? Why would
without value judgment? I'm looking at
no,
finances, right?
All right. So and I looked it up. I mean, you could have significant itemized deductions limited by adjusted gross income would be one. You could participate in income-driven repayment plans for student loans. That might be another reason. You might want to separate your tax liability from your spouse's. You might live in a community property state. There are, and we could go on and on. So there are a number of planning reasons that you might filing separately. But one of the things that I love about the tax software that we have is there is a page that you can look at that says the taxpayer's income was this, the tax liability on that was this, and this is what they paid in toward that. The spouse's income was this, their tax liability would have been this, and so you can see, well, who's really pulling their weight here and paying their fair share. Now, if it's a pooled bucket, who cares, right? If someone's overpaying and someone's underpaying it, and it all works out. But there are sometimes situations where you say, how do we do this? But I don't ever remember seeing where calculating it to file married filing separate puts someone in a better position when they're done with the tax bill if they filed separate versus filed joint.
Yeah, it's usually some other planning reason or whatever. But most of the folks that I see filing married filing separate, it's because it's a second marriage situation, and they just declared at the front end of this relationship, we're just going to keep everything separate. We're not going to commingle anything, and that way we don't have finances become an issue to argue over or anything like that. So, sometimes it's just sort of a life decision that causes you to go down this path. And when you realize, oh, that's actually costing us some things, or it's making a Roth contribution not really possible for us, maybe you have a heart-to-heart with your spouse and say, you know what, maybe this is a time for us to begin merging that part of our life together. And to Kevin's point, you can still keep it separate. As far as how much refund does each spouse get, or how much does each spouse have to pay in taxes, that is still knowable. But you're just collaborating differently on the tax return to maybe open up some possibilities like a Roth contribution.
Yeah, ask your tax preparer to show you that data. And the other thing is, Josh, like you said, if I made that decision on the front end of a second marriage, I would allow for things to adjust, because as I work with folks that are on a second marriage, if they felt kind of burnt or betrayed or fill in the blank from the first marriage, it's really tough to combine things in the second marriage. Or sometimes they've worked an entire lifetime and they lost their spouse, and now, okay, does all of this, which was going to go to our kids, now go to my new spouse, or my new spouse's next spouse, or my new spouse's next spouse's kids? And so all of a sudden you say, well, wait a minute, it might be too painful or too difficult to consider a combining or commingling. But if, in my experience, if you want to work toward intimacy in your marriage, you've got to find a way to remove finances as an obstacle to that. And that's a lot of times where combining at some level will assist in that, or encourage that intimacy that you want to have in your marriage.
Yeah.
Next question from the same video on YouTube came from Mark, and he said, I have a Roth 401k with my employer. I plan to work for this company past age 72. In the year I retire, age 72 or later, do I need to take RMD on my 401k, or can I avoid it by rolling it into the Roth IRA before year end? I got back to Mark as well. And so the first thing, and this is all from a Next Wise Step video that says, yeah. Do you need to take RMD from a Roth 401k? Yeah, actually you do. There's the gotcha. Now, while you're still working, you don't need to, but if you leave it there, you've got to. Do you need to take RMD from a Roth IRA? No, you don't. So Mark's saying, hey, I'm aware of this rule. Can I just avoid it by when I retire, just quickly sneak it over to my Roth IRA? And I told him I can't see the rule, but the reason why you've got to do RMD from a Roth 401k is it's blending the rules between Roth and 401k. And I think the 401k rule is going to take precedence here on the way out. And that is, if you've ever rolled a 401k over to an IRA when you're supposed to, when you're obligated to do an RMD, required minimum distribution, they tell you, okay, we've got to take RMD on the way out the door. So we're going to send you your RMD and then we'll roll the rest of the money over. I've never seen it when you're required to do RMD where they let you roll it all over to the IRA and do your RMD there. They force you to take it out during the rollover process. So Mark, that's what I shared on YouTube. I'm pretty sure. I mean, we don't say those words here, but I'm pretty sure you're going to need to take your RMD on your way out the door of your Roth.
Yeah. And I would think, Mark, one of the things that I would encourage you to do is see what the rules are for your plan. Some plans allow for in-service distributions. Mm-hmm. Some plans allow for, you can move all your money out after you hit 59 and a half. So there are all kinds of different rules. Look at your plan document, talk to your administrator, but find out what your options are, because you might have some pretty sweet options.
That's great. Thanks for the question, Vanessa and Mark. Thanks for your listenership of the Wise Money Show. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, myself, all of us at Korhorn Financial Group, we'll see you next Saturday right here for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.